All right. Oh, I didn't press record.
I did.
Oh, you did?
Yeah.
Nice. One of the co-host privileges. Right. I wonder if I'm going to press record on mine. I'll record twice. How exciting. So
I assume you can record. You can record as well.
Yeah, I think so. Yeah.
I'll record it for my records as well. So
yeah, sure, that's absolutely fine. Do you want to practice sharing your slide or slides? That's the first one, just so we can check that works before I hit record on mine. I'm awful at doing editing, so I like to hit record and then stop, and that's it. Oh, good. That's shown up well. All right. Well, I'm going to get started. So I'll do a little intro and then sort of bring you in. Welcome everyone to the Cup of Coffee podcast with me, your host Tom Dillon. This has been recorded live at our weekly online meeting and broadcast around the world. Today's topic is an introduction to bridging and development finance with Alex Blakeborough. Before we start, I'd just like to say by way of a disclaimer that today's a wonderful discussion, but nothing said here constitutes financial advice. You should always take professional advice before investing your hard-earned cash, maybe the odd unplanned swear word along the way as well. The format for today is that Alex will speak to us for a while, and then we'll be taking questions from the floor, so we'll get those ready if you're at the meeting. Alex is a development finance, bridging and private equity expert. He's also an HMO investor, keynote speaker and serial networker, and prolific value provider across social media. He's also the founder and owner of AB Finance Limited, a whole of market broker. Good morning, Alex.
Yes, good morning, guys. So, first of all, thanks for having me on the show, the podcast, whatever you want to call it, and look forward to hopefully enlightening you on some bridging and development finance. Just a really quick introduction today. So, if we're ready, I'll fire away. Can you see my screen? We're all good to go? Perfect. So first of all, just a brief introduction. So this is me, Alex Blakeborough. Mobile numbers there, and email, and do connect with me on LinkedIn if you have that LinkedIn, and do scan the QR code as well. As I say, I put out a lot of content across social media, so feel free to connect. A lot more content coming out there as time goes on. So just really quickly, what we do, as Tom's kindly mentioned, we specialize in development finance. We have private equity options, bridging finance, so that would incorporate sort of your commercial conversions, new build developments. Auction finance is a big one as well. Flips, so if you're buying properties and then flipping them on, doing them up, and then selling them on for profits. Buy, refurb, rent, refinance. So really popular strategy, obviously, throughout property, whereby you can pull out your capital by refurbing properties and doing them up, and then pulling it and then refinancing. I've also got mezzanine options, those sort of bolted onto the, in addition to development finance to increase loan to values, buy-to-lets, HMOs, and any other property finance. So feel free to connect, always happy to assist. So first of all, a bit of a market update for you guys. So stagflation, not sure whether everyone knows what that means. So currently in the market, we've got a situation where there's pretty stagflation's in existence. So that means that we've got high inflation, and we're also going into, unfortunately, recession. So as a result, we're always going to have, when there's high inflation, higher interest rates to combat that inflation. Try and decrease the likelihood of borrowing in the economy, and increase saving to try and combat that inflation rate. So as a result, as I say, the Bank of England has upped the base rate from 0.5% to 1.75%. We're expecting further increases as well, with inflation skyrocketing. So what that means is the cost of borrowing, specifically in the bridging and development finance market, the cost of bridging and development finance lenders is increasing. The reason for that is that obviously the majority of your lenders will get their funding from banks, basically. So their rates, the bank's rates going up means that the cost of borrowing to bridging and development finance lender is rising as well, which means that, unfortunately, with them requiring this to make the same margins, and they've got the same costs. If anything, we're going to be seeing increased pressure on salaries, so their cost of labour is going to be increasing as well. So unfortunately, that's going to be passed on in the forms of generally across the board interest rates on bridging development finance rising as well, unless of course those lenders are privately funded. So privately high net worth individuals, we do have some bridging options where they're maintaining holding their rates and trying to absorb the interest rate increases. So increasing build costs for your refurbishments and cost of labour due to increase in cost of living, sort of in energy bills, that kind of thing, is all rising. So again, that means the cost of labour and build costs, that kind of stuff, and materials are increasing as well. So that in conjunction with house prices perhaps stagnating and the market resetting is going to result in generally lower profit margins in your developments. I mean, we may be able to pick up sites cheaper in the not too distant future, but wherever there's some uncertainty in the market, and we're a bit uncertain, lenders will generally reduce their loan to values to cover them. So increasing interest rates and reducing loan to values doesn't sound great, but we still do have good options, and as I said, we're trying to absorb as much as possible for our clients, basically. So some lenders we've actually agreed to reduction in our proc fees, which isn't ideal, means we get paid less, but we are doing our best to try and in conjunction working with lenders, trying to absorb as much as possible of those increasing rates. So still good options, and always remember in adversity there's always opportunity. So I think at the end of the day it's not a time to stop investing. There's still going to be deals out there, so keep calm and carry on, guys, I suppose. So just move on to what exactly is bridging. So bridging is a short-term lending solution for a short-term lending requirement, generally where a mortgage isn't suitable. So this is going to be the main reason you use bridging is when the property is too run down to rent, and therefore mortgage, because it's not going to be bringing in the rental income. So it's key to always use the correct form of lending for your requirements. So we do get quite a few people, generally those that are kind of new into the industry, think they think that they've got sort of a magic solution to get around bridging, and they use mortgages where they should be using bridging. But I think the key is that all sort of your seasoned investors are using bridging. It's a great tool, as I say, for buy, refurb, refinance, flips, and these kind of deals. So I think the key is to, as I say, use bridging where it's required, where it's demanded, as opposed to trying to get things to scrimp and save on a mortgage. It's just not a strategy you can rinse and repeat. So a lot of things people aren't aware of. There's something called the Hunter report, by where lenders compare information, basically. So if you're using a mortgage, I mean, probably a bit too strong to say it's mortgage fraud, but if you're using a mortgage where you should be using a bridge, lenders will suss this out, and they compare that information, and you'll end up getting blacklisted, basically, from valuable lenders who you may be want to use in the future. So let's say, make sure you do things properly, and all FCA brokers should advise on the correct product for the correct requirements. So knock-on effect of that is that brokers can be cast off lender panels if we're trying to use mortgages where we should be using bridging, for example. So bridging uses, we've sort of touched on these, but buy, refurb, rent, refinance. So that's a strategy whereby you're going to be you purchase property on a bridge, go take it through a refurb, so put your touch on it, make it nice for tenants to be coming in, So rent it out and then refinance. So the idea with this is that you're recycling your capital as much as you possibly can. So it makes your capital go further, basically, as opposed to if you just purchase on a mortgage, put some tenants in, that deposit has then gone, basically. So if you buy deferred rent refinance, then hopefully we can recycle some of that cash. You might struggle to pull out all your cash nowadays, but it's a really good strategy for recycling as much of that capital as possible. So conversions, though, HMO conversions, commercial to residential conversions, are always going to be bridging, basically. As I say, you're not going to be pulling in the rental income, so yeah, you always use a bridge for conversions unless you're using cash, and then either sell the property on or refinance out again. So flips, I suppose, is a type of conversion, but probably smaller scale. It varies from deal to deal, obviously. So if you're purchasing a property on a bridge, we can also look at getting the refurbishment funded potentially, depending on the level of the refurb, and then you would increase the value, as I say, do the property up, and then sell it on for a profit. Capital raising. So this is another interesting one. So recently, just to give you an example of a recent deal, we had a deal where we had a businessman, so he's running a business, and he had a legal suit against him, and it was a fairly expensive issue that he had, and he needed to get hold of some money really quite quickly to solve his legal dispute. So we put a second charge on his residential property, and we managed to complete that deal within a week for him, pulling out 50, 60 grand, something like that for his legals. And yeah, so that's another option for bridging. Below market value properties. So AB Finance, we've got options up to 90% of the open market value, which is a really good option. If you can find below market value properties, those unicorns, perhaps if you direct to vendor, or if you've got distressed sellers, or you've got someone, a connection perhaps of yours that's going to sell you it for a bit of a discount, we can go off 90% of the open market value, which with one particular lender we can cover 100% of the purchase price. So without actually having to put in any capital whatsoever, we can then refinance out. It really helps if you're doing well, in fact, there is a caveat to that. We need to be, the lender won't lend more than 75% of the gross development value, so the done up value. So 90% loan to open market value, as long as that is no more than 75% of the done up value. So that's a really good option as well for below market value. Planning gain. So another option, say you are purchasing a commercial unit, for example. I'm going to take it through planning to increase the value. Obviously, once you've got planning in place, then that value of the property is going to fly up. So even if you don't want to do the refurbishment yourself, then it's a really good option to bridge, take it through planning, and then sell the property on for profits again. Lease option agreements, lease exit and refinance. So lease options, generally you'll agree a price that you're going to be leasing the property off a landlord for a certain amount of time, perhaps 2 years, something like that, and then you'll agree a price at the end. So again, discounted. So to exit that lease option, you would bridge perhaps the open market value again of the property, and then minimizing the amount of capital that you have to put in again, and then you'd refinance onto a term mortgage. So it's a nice way of exiting, and that's a really good strategy as well. So yeah, one thing that people forget is that it's a way of vetting your figures to make sure that the deal stacks. So lenders aren't stupid; they're not going to lend on deals which don't stack up from a profit kind of margin. So if you're basically if there's no profit in the deal, a lender won't lend. Whereas if you're purchasing cash, then there's no one vetting your deals basically. So it's just a way of sort of reassuring you that there is profit margin in your deal, and yeah, the deal will work basically. So just, I think I touched on a couple of these, but differences with a mortgage. So it's based on the assets and the profit margin in the deal, as opposed to the individual credit rating, income, etc. So the reason for this is that obviously whilst you're refurbishing, the property isn't going to be rented, so it's not going to be bringing in any income. And because of that, generally, the interest is rolled up or retained for the period. That means that you don't have any monthly repayments. Yeah, as long as your deal works, as I say, going back to that last slide, as long as there's a profit margin in that, whether it's a flip and the GDV, you're seeing an increase in the GDV, the lender will lend. It's not so crucial for you to have a really good credit rating and that kind of thing. So people with adverse credit, we can look at bridging and doing flips, that kind of thing. Whereas the remortgage is more important. It's more important to have a really good credit rating and have a good rental income. As I say, on bridging, if the deal is making a profit and you're increasing the value, then generally we'll get you some form of lending. Mentioned already that interest is usually retained or rolled for the duration of the loan, because obviously you don't have the rental income coming in whilst you're refurbing, so therefore there's no rental income as such to cover your repayments to your mortgage lender. We can look at serviced options, although these come down to that will be more strictly sort of underwritten, in terms of you will need a really good credit rating, and you also will need some capital available. The reason for that is obviously because the property isn't going to be pulling in any rental income, so there isn't, there's nothing to pay your repayments. So that's probably going to be even more strictly, well, it is going to be more strictly underwritten than actually having a mortgage, because there's no rental income coming into your pockets basically. So rates and loan to values. So these are all monthly on bridging as opposed to annually with mortgages. So you'll see brokers advertise from 4.5% per month, but those are at really low loan to values. So below sort of 50% loan to value. Generally, if you're using bridging, you're going to be wanting more than that. But if for example, you're looking at a capital raise, something like that, we can get rates from as low as 0.45% per month. But generally, moving on, your market leading is going to be around 0.65% at 75% loan to value, or 0.55% at 70% loan to value. These are sort of without having the refurbishment funded as part of the bridge as well. So these are sort of more vanilla lenders, might take slightly longer to get your deals through, but we can achieve those rates. Those are very achievable. As I've mentioned already, we do at AB Finance have options up to 90% of the open market value, which is really good for your below market value properties. And also, to be honest with you, it's good for just high loan to value, as long as you are increasing the value. As I say, they will lend up to 75% of the done up value or 90% of the open market value. So a really good option. We've got an auction purchase going through currently where there will actually, with it being an auction, the surveyors will generally go off the purchase price, because what this lender does in particular is that they won't divulge to the surveyor the purchase price basically. So they make the surveyor work a little bit harder basically to get a genuine valuation. So really good option again for those below market values. So generally, we've got a maximum of 75% loan to purchase price or the 180-day value, whichever is lower. So to get those market leading rates of 0.65 and 0.55, the lender's going to go off the lower of the two. So the lower of either the 180-day value or 75% of the purchase price. It's only sort of the more specialist kind of niche lenders that will go up to 90% of the open market value. I mean, we do have options up to, the majority of lenders will that we work with will go off the as I say, the lower of the two, but probably about half, maybe a bit less will go off the open market value, and they'll go up to 90% of the purchase price, but not 100% like we do with a couple of lenders. So always happy to help, as I say. Factor in that the arrangement fee. So of that 90% loan to the open market value, we're going to have to deduct the arrangement fee, which is generally 2%. I think that's on the next slide. 2% in bridging is across the board is what you're going to be looking at. Interest at 0.65 or up to perhaps 1% with different lenders. They're going to deduct the interest for the period from your day one gross loan to give you your net loan. So factor that in, that with mortgages, 75% loan to value is going to be 75% is what you get cash in hand. Well, not cash in hand, towards the purchase price, but with bridging, it's going to be quite a bit less than that. You might be looking at more like 65% at 75% loan to value. Certain lenders, I think on the next slide, will roll the interest up, but generally it's going to be retained, which means deducted day one. So costs. So under no illusions that bridging is a cheap form of lending, as I've said, but it is a great tool, and the majority of your seasoned investors will either be using bridging or investor funds to adopt these strategies such as conversions, flips, buy before refinance. Always going to be using bridging, so it's a really good tool, as I say. First of all, we have a broker fee, so that's my fee. Obviously for cash flow reasons, but the majority of brokers will charge you a broker fee as well as the prop fee that we get from the lender. So I charge £699 on application, which is not extortionate. It's not expensive at all across the market. A lot of brokers will charge sort of £999 as a minimum broker fee, up to 1%, depending on the deal and size and etc. But yeah, I mean 1%, an extra 1% on a deal which 500 grand is an extra £5 grand. So we just charge us £699 on application, and then we get our prop fee, which, as I say, is unfortunately reducing in quite a lot of instances at the moment. So valuation fee next. So with bridging, you've got kind of a three-pronged valuation. So we've got obviously the current valuation, so what the property is worth currently. They'll also want to look into your costs of your refurb. This is all on refurbishment, really. So they'll need a QS or an asset manager to run their eyes over your costings and look into what you're doing to the property and make sure that tallies up with what they expect. You can imagine they don't say, oh, it's going to cost that, and then they're okay with, they just give you the nod. They don't put that much trust in you, unfortunately. So they'll need an asset manager to run their eyes over it, and also the GDV or done up value. Basically, they'll need to make sure that stacks up. So for that reason, your valuation fees are going to be more expensive, because as opposed to a mortgage lender going out, they just have to look at the current value. With the bridging, that's a three-pronged kind of valuation. So more expensive valuation fees, and also again, with legal fees as well, it can be more complicated, which again, more complicated, and with valuation and legals, with bridging, we need them to be done quicker. So anything that we're looking for speed comes at a premium as well. So legal fees, valuation fees are generally more expensive due to more complicated and more speed required. So arrangement fee, as mentioned, 2% generally across the board with your bridging lenders. Again, that's deducted from your gross loan amount day one. How are we doing for time? So yeah, so arrangement fee deducted. You might have an admin fee with certain lenders as well. Again, that's deducted generally from your gross loan. Title insurance. So you can imagine that you need to insure your property. That it's more likely on a bridge with it being vacant for vandalism. Squatters coming in. So you need that insurance. Might a lot of lenders charge that because it's more expensive, as well. So yeah, asset manager fee. So I've mentioned we'll need an asset manager or QS to run their eyes over the costings of the deal and make sure that they tally up with what you're doing. So make sure that their idea of how much things are going to cost tally up with what you're expecting, and they'll need a schedule of works to look over as well. For heavier refurbs, you'll need a QS again, which is another cost, especially on development finance. You're going to need someone going out and looking at what you've done, making sure you've spent what you said you were going to spend, and making sure it all stacks up. Refurbishment bridges. So these are based off the GDV, so they're done at value. Maximum 75% loan to GDV for experienced borrowers, and maximum 75% loan to value day one, again for experienced borrowers. If you've got, we must have a very experienced contractor who's done at least sort of 10 of these projects previously. If you don't have the experience there, so if you're new to it, don't worry. But we need to be using an experienced contractor, excuse me, who's got a really good website, good reputation to get those loan to values up. That's if you haven't done sort of 3 similar sized projects under your wing. So present applications as professionally and organised as possible. So if you can imagine to get through underwriting, we're going to have to try and sort of put things to lender and package them up as organised as we possibly can. With my help, obviously, we try and present things to lender as organised as we can. Basically, reason for that is that you can imagine if things come in dribs and drabs and into the underwriter, then it's not a deal that's as appealing to them to get through as something that's packaged together very neatly. As mentioned, current loan to values are generally lower at the moment. So that's due to uncertainty and perhaps margins being a little bit lower, and generally just down to uncertainty. So these refurbishment bridges, as I've mentioned, are really, really good. By refurbishment bridges, I mean basically that we can get the refurbishment funded as well as the loan to value day one. So a really good option, and I won't go into too much detail, bit push for time, but the way these facilities work, the drawdowns are always done in arrears, basically. So they don't give you a big lump sum of cash day one and say, there you go, off you go with off you go do the refurb. They very much vet what you're spending your money on. So again, with the asset, in conjunction with the asset manager or QS, they will go out, at sporadic sort of intervals and check that everything you're doing is what you said you were going to do. They'll check your invoices and make sure that you pay, you're paying, and everything's accounted for basically. And then say you've spent 20 grand, they'll then release 20 grand for what you've spent, and then you can go again, basically same process happen again. So you might be looking at, so some lenders don't have sort of a one-off fee for the for the asset manager, but the majority of lenders will have a QS or asset manager that goes out, and that's a fee of perhaps 600 to £1,000 each time that they go up. So it's more expensive in terms of those costs. Another thing, make sure you document your journey. So it's really good for lending. We really want to make you look as risk averse as possible. So keep a record of everything you've done. So if we can just have a nice portfolio, perhaps some before, during, and after photos of all the projects you've done, and then put it into sort of a portfolio, the property address, what you purchased property for, what you spent on it, and what you refinanced it for, or what you sold it on for. That kind of stuff is really, really handy, and really, as I say, puts the underwriting but underwriters at the lenders at ease a little bit more. It's all about put the lender at ease and making you investable, basically, similar to what you would do with a private investor. So I think that just brings us on to a couple of really quick examples. A deal that I've done with the client recently. So this is a bridging example using a second charge to achieve 100% funding, basically. So the purchase price was 350,000, refurb 220 with a GDV of 750. So this is a flip. They also have a residential property with a value of 1 million, an outstanding mortgage of 50,000. So the client borrowed 70,000 on a first charge on the property they were purchasing, less interest, and used a second charge on their residential as a deposit. So they've just whacked basically a second charge on their residential property as leverage, basically. So the lender funded the full purchase price, and actually lent them another 50 grand to start the refurb. So the lender then funded the full development costs in arrears in accordance with the GDV. So that 50k, you might be wondering, so that's basically so that they don't have to put in any of their own cash. So they spent that 50k, they then call the lender out to then do their drawdown. So 50k spent, asset manager out, they okayed everything, they're going to okay everything that they've done, and then they go again with that 50k. So they don't have to put in, that's a no money down deal, and a really good way of using second charges if you have equity in your property. Really quickly, finally, deferred consideration, development finance. So this might be more commonly known as vendor finance. So on this one, we had a site purchase of 800,000, planning for 6 new build properties. So the lender then lent 400k towards the purchase, and the vendor agreed to receive the remaining 400k on the sale of the properties. So the vendor accepted half of the money up front, which the lender funded, and then the remaining 400,000 was paid to the will be paid to the vendor on completion of the sale of the properties. So the lender then funded 100% of the 1.2 million build costs in arrears. Well, they will be doing that, and the GDV is 3 million, so it's a nice deal. Which meant that the client only had to have around 50,000 cash flow to start the build, with the remaining 400,000 paid to the vendor on the sale of the property. So if you can use your negotiation skills to try and get convinced that the vendors that that's a good deal, which obviously is down to yourself, then we can look at getting 100% funding on developments as well. So could do more examples, could go on all day speaking, but that's me for now. Just bang on about 35 minutes, so happy to take any questions. So thank you very much, guys. If you have any questions, I'd be delighted to arrange a call. Thanks for your time. Just my details again up there, so feel free to connect with me on LinkedIn. Particularly, we've got a very substantial following, around 26,000 on LinkedIn there now, and happy to advise on HMO market, and do book in. If you scan me, if you scan that QR code, then you can book in for a free, no obligation chat, and learn a little bit more if you like as well. And thank you very much.
Thank you, Alex. Really enjoyed that. Sort of a really interesting update on sort of where we're at in the market. Obviously, with interest rates doing what interest rates are doing, then a look at different types of finance that's available, and then finally a couple of case studies. I know some people, including me, like as well. So let's put some sort of numbers to the theory. So really good, really interesting. Really enjoyed it, and I've got lots of questions. If anyone listening live's got some questions, pop them in the chat or shout them out. I was thinking property is about two things, isn't it, really, which is finding some deals and finding some money. And obviously you and your company help with the second part of that. Finding deals is up to us, and finding help with the money is at least in part up to you. I was thinking if people, so a lot of people, when I started out, I didn't know what bridging finance, development finance, these kind of things. I think these products were out there, and that they were potential solution to the problem of, I've got an unmortgageable property, or I've run out of cash, and I want to get the next project over the line, I want to get it done. And so I suppose my first question would be, if someone's in that situation, they've done a couple of projects, but they've run out of money, or maybe more relevantly, they've come across a property that simply isn't suitable for mortgage finance because it's not tenantable, not ready to go, needs a lot of work. This is really something that can help, isn't it? I guess this is where you guys can help out.
Yeah, exactly. So just can you reword the question, just to mention as well. I'm gonna stop screen sharing as well now, guys. So if you want to scan or take my details, I'll bob my details also in the chat. I'll stop sharing, and so we can see each other again. So thanks, guys. Sorry. So yeah, can you reword that question there, Tom?
Sure, no problem. So, well, let me reword it in a like almost totally reword it, because I think it make it clearer. Which is, I'll start with start of a 10. That'll help me to ask better questions. Which is, what's the difference between, you mentioned bridging finance, you mentioned development finance, and then at the end a refurbishment bridge, which seem to be sort of a third kind of way of doing things. What would be in simple terms the difference between those three things?
So between sort of a straight bridge, a refurbished bridge, and what was the last one? Sorry.
Development finance.
Development finance. So differences will be a straight bridge is just we're looking at bridging on the current market value. So as I said, they will look at what you're going to be doing to the property, but it's just a matter of they're bridging on the current value more than anything, really. So if you do it, it's really for light refurbs. So there won't be a QS involved or asset manager, that kind of stuff. Refurbishment on a refurbishment bridge, you're going to have obviously drawdowns. So you might be slightly reduced day one. So you might look at, especially with heavier refurbs, the loan to value generally will come down a little bit. So you might be looking, as opposed to, if you're on a straight bridge, you're going to be looking at 75% loan to value. Refurbishment bridge, you might be looking at 70%, and heavy refurbs, you might be looking at 65%. These are all day one values. Now, with refurbishment values as well, you have more options of rolling up the interest on top, as opposed to retaining it. So, whereas you might be getting a gross loan to value which is lower, it might actually not be that different, because you can roll the interest on top, which means it's slightly more expensive. But we're going to retain the it might not work out that much different. A lot of it just depends on the lender as well. A lot of lenders retain the interest regardless, and some will roll the interest up if it's a refurbishment, where you're not going to get rolled on a straight bridge. And also I've made reference to we'll need a QS or asset manager. QS is as the level of the refurb goes up, heavier refurbs, we're definitely going to be more involved with QSs and more monitored in terms of what you're doing. And again, and more so with, in fact, a lot of point to make. Some lenders will look at a commercial refurb as more kind of risky than a new build, because there might already be sort of issues with the building, that kind of thing. Whereas if you start from scratch, houses are generally built pretty well nowadays. It can be seen as less risky. So again, with development finance, similar to refurb, you're going to have a QS involved from day one, and they're really going to be quite rigorous with the process. Whereas straight bridges we can get through quite a bit quicker. So hopefully that helps.
Yeah, brilliant. Really clear, I think. So wanted to touch on, you mentioned the and I might get some of the terminology wrong here, but I'm sure you'll set me straight, which is you can get 90% loan to value if, for example, the property is below market value, so that it still stays below 75% of open market value rates. But that just struck me, what a powerful tool that is. Of course, it requires a ideal like any product, but maybe a lot of people out there, maybe including me, didn't realize 90%, sometimes even 100% funding can be available on these things. If you find the right deal.
Yeah, exactly. So this one lender in particular, I mean, in fact, whereas a lot of lenders are reducing loan to value, this lender's actually gone the other way. So they're going up to 90%. Just shows that their product works well, obviously, and they're happy to do that. It sort of sets them alone, and it's really good that they don't divulge to the surveyor basically what the purchase price is. I think that's the key thing, because generally surveyors are fickle creatures at the best of times. They'll just go off the purchase price as opposed to the open market value. It covers themselves, and also it means they don't have to work as hard, I suppose. But that's a really good option, as you say.
I was going to say about my next question actually was about this, the fact that they don't tell the surveyors the valuation. Now, I'm sure if they dig hard enough, maybe they could find it, but I think ignoring that for a second, like I think it's a surprise to me in the industry that doesn't happen more. Like if I was the mortgage works or pick a lender, it could be anybody. I don't think I'd be telling the surveyors what the applicant has said this property is worth. I'd go out and say, you tell me, that's your job. But it's surprising how infrequently that happens.
Yeah, exactly. I suppose that from the lender's point of view, that to a certain extent, the lower the valuation, the better. And I think that they're a lot because it means that they're covered basically. And I think it gets them a bit fidgety if you're purchasing it for less than what it's worth.
I see. So
and I think that a lot of the time there's behind closed doors. I think that a lot of lenders will try and sort of have a word with the valuers, and there's probably a little bit of collusion that goes on there, to be honest.
Lovely. I totally understand. We've got a question in the chat to get to in a second, but I wanted to just ask him in sort of broad terms, zoom out a little bit. Do you think bridging's changed much in recent years? Obviously, we've got the context of rising interest rates at the moment, but do you think generally the industry's changed much, or is it much as it was? Or has you've not been doing this for 50 years, but
a few years ago, there used to be a few lenders actually that would lend off the open market value, and up to 100% of purchase price. Two of them went bang. So it's probably what a reason why lenders aren't keen to lend on the open market value as opposed to the purchase price. But has it changed much generally? Well, obviously, through COVID and stuff, loan to values went right down. Where there's uncertainty, generally the loan to values will will go down. It just blew all my deals out of the water. I lost thousands and thousands of pounds when
Wow.
when those loan to values went down. People didn't, and just the uncertainty, people didn't have a clue what was going on, and lenders were down at sort of 55% loan to value, some of them. So it was
So COVID really hit.
yeah, massively. You know,
Yeah.
my pipeline just vanished like that, gone. So yeah, COVID had a massive impact. But yeah, good options, and lenders are always open to suggestion. AVMs, I've done actually a post recently on AVMs, so they're coming in, or desktop valuations, they're coming in more and more. So valuation prices have generally increased as well. Part of that's due to PI insurance flying up, basically, so that's got to be passed on to clients when the market has just been crazy busy, which means that availability isn't quite as good. So they've been putting up where they aren't as available, they put prices up, and again, perhaps that's why AVMs are coming more as well, to try and speed things up a bit. So
I feel like
I've recently done a quick video on AVMs and that kind of thing. So as I say, I put a lot of content out there as well. In fact, I'll just post my details again in the chat.
Yes. Speaking of details, as Alex is doing that, for those listening to the podcast, we will, of course, as always, post Alex's details with the show notes. But we also know that some people like to just listen and, tell us now, Tom, tell us now what the details are. Well, with that in mind, Alex has got lots of details, but you mentioned he's very active on LinkedIn. So that's, to search for him, just looking for Alex Blakeborough, and his surname, for those who maybe aren't in the UK, or if that's not an obvious spelling, it's Bravo Lima Alpha Kilo Echo Bravo Oscar Romeo Oscar Uniform Golf Hotel, and then AB Finances, Alpha Bravo Finance is his company name.
Yeah, I would say I'm very active across social media. It's a fairly unusual surname, so on LinkedIn I should pop up straight away. As I say, I've got approaching 27,000 followers now. So any other questions? So I noticed there was a question there.
There is. So why don't I read it out and then you can answer it? That sounds that'll sound professional, won't it? So Brahma asks, in the examples you gave, what were the costs involved and what was the interest rate? Now, you might not remember all off the top of your head.
Yeah, so let me just get those examples back up. So where are we? So on the flip, so rates on that one was, I believe, 0.73%, because it was a fairly low loan to value. We managed to get them a really good rate. Now that lender has recently increased rates. We're not going to get that currently. Probably looking at 0.87 perhaps on that one. But it's not a massive increase. That lender I've had to suffer a reduced prop fee as well, which isn't ideal. But so what were the costs? So the interest rate was 0.73. Did I say? Yeah, I think 0.73. And the costs. So obviously we'll have two valuation costs on that one, because you've got to get a value on the residential and a value on the purchase property. Obviously we'll have an asset manager going out, so that's about, I think it's about 700 each time the asset manager goes out. So that would be, my math's about right, 7 times, probably 5 drawdowns on that, I think. So that bumps up cost as well. QS report initially as well, and 2% arrangement fee, no exit fee. Some lenders have exit fees as well. And yeah, that's about your lot on that. 699 broker fee. Valuation fees, I can't remember those. I think maybe 2,000 and about 2,000 each. Legals maybe, I think 2,500, something like that. And on the other example, 2% arrangement fee, 1%, 1.5% exit fee with that lender, Rate, I believe, on that one was 0.79, I think, per month. So it's a development finance and bridging lender, that one, which is and that those guys are actually contractors as well. So this is their first development. So we got a really good rate on that. So 0.79, and obviously you have your QS fees as well, around 800 quid per visit, I think. Legals were more, I think, about 4,000, perhaps. Valuations were about 5-6 on that, because it's a larger deal. So yeah, hopefully that helps. Ballpark figures.
Yeah, absolutely. Hopefully that answers the question. Just finally, I'm trying to sort of finish on a sort of positive note, because, well, I was first of all comment that those fees sound really high, but then when you realise you're talking about developments of millions of pounds,
yeah,
point 1, point 2 is that if the even with sort of slightly higher fees, not high fees in terms of the industry, but high fees compared to, say, getting the mortgage, but then like that, if it works on your numbers, if you're still making a very healthy profit at the end, then that's fine, isn't it? It doesn't matter that if you're paying £1 million in fees, for example, which of course you're not, but if you were, it's fine as long as you're making 10 on the back end.
Exactly. Yeah, I mean, it's all relative. They do sound expensive, but you know, that deal's got £1 million profit in it, hasn't it, or whatever.
Yeah.
So yeah, £1 million profit. So
yeah,
those fees are not much out of your profit
percentage, very low. You mentioned, lastly from me, in adversity there's always opportunity, and you touched a little bit on what you felt those opportunities were. Is it things like, I was trying to sort of come back to that, as finish on a positive note, is the opportunity for us as developers, as investors, that maybe prices will start to drop, but to reflect the sort of more difficult market?
You know, hopefully there's going to be more deals out there, and you know, hopefully some landowners trying to shift, get rid of sites and this kind of thing. You know, when they see prices going, perhaps dropping a bit, it gives you more of a bargaining tool, doesn't it? For, you know, perhaps if landowners are struggling, being made unemployed or whatever, you know, just keep your eye out. It really is uncharted territory and uncertain, isn't it? We all want to have a crystal ball to see what's going on in the future, but I think the key is that there's always deals out there. Keep calm, carry on, and there's always investment opportunities. And I posted a Warren Buffett quote recently. He, you know what he's like, stats wise and all this. He reads all these books, whatever. So he said, you know, guarantee me that there's recession, I'd still be investing in the same assets, you know, and the same things. So try to a certain degree to ignore what's going on if you've got the capital there, and property in the long run, you're always going to make money, you're always going to see capital appreciation. So why not get cracking now?
If the fundamentals are good, then keep going, eh?
Yeah.
Smashing. Thank you very much, Alex. We appreciate both that answer and everything you've spoke to us about today. Really appreciate you taking the time. I've got people in the chat saying, Andrew's saying she really enjoyed today's presentation, as indeed, of course, did I. So that's great. For anyone who listening to the podcast or maybe thinking about coming to the meeting, then do come along. First of all, it's great, but also because we have a very active WhatsApp group with like 270 investors on there at the moment. So if you want to get involved in that, then our only sort of rule in inverted commas is that you attend at least one meeting. So do feel free to come along. Again, with this podcast, I think with all of them, in fact, we post a link to the meeting so you can come along anywhere in the world, of course, as long as it's you can come in the middle of the night if you're in various parts of the world, but that's of course up to you, or you can catch up with the podcast as you might well be doing now, and we really appreciate that. Thanks again to Alex for speaking to us today.
Thank you very much, guys. And as I say, I've bobbed my my details in the chat there, as well as, hopefully, you know, you've done the scan code, or see if anyone is connected on LinkedIn, Facebook, etc. Always here to chat, guys. And I do have options. You know, I'm working Saturday morning. We do have options to discuss outside of working hours as well. So feel free to reach out. I'm always available on WhatsApp as well, and you know, through all the various social avenues.
Super. If anyone's got any feedback, or thanks, Alex, if anyone's got any feedback ideas for future topics, which is, of course, then please get in touch. Let me know about any great speakers you might know. That's how we got Alex on here. So that's important as a lifeblood for our meeting. And yeah, as I say, if anyone wants to put in, I think somebody already has asked me about the WhatsApp group in the chat, direct message. I've received that. I'll get you added to the group if anyone else wants me to do that. When I leave in a second, I'll leave the meeting open, and then you can just pop your first name, last name, and phone number in the chat and get you added to the WhatsApp group. Thanks everyone for being here, lastly, and have a great weekend.
Thank you very much. And if you wouldn't mind adding me to the WhatsApp group as well,
Yeah.
feel free to fire some questions at me.